What exactly is a fair value gap? Think of a fair value gap as a price imbalance. It occurs when the market moves so aggressively in one direction that it leaves an unfilled gap between candles. This gap represents an area where price didn't spend enough time trading. Here's the interesting part. That imbalance often acts like a magnet, drawing price back for a retest. Traders who understand this concept use fair value gaps to identify high probability entry zones with greater precision. So, how do you identify one? Start by looking for a sequence of 3 consecutive candles. You're looking for a strong expansion candle in the middle, positioned between 2 comparatively smaller candles. If the high of the first candle and the low of the third candle do not overlap with the range of the middle candle, a fair value gap has been created. That empty space between the first and third candles is the fair value gap. Once you've identified it, draw a rectangle over that area. It now becomes your point of interest. This concept works in both directions. In a bullish market, a fair value gap forms during an aggressive move higher. In a bearish market, it forms during an aggressive move lower. Just remember, if there's no gap between the first and third candles, then there's no valid fair value gap, no matter how large the middle candle is. Now, let's look at the theory behind why fair value gaps work so consistently across different markets and timeframes. Imagine this bullish fair value gap was created on the daily timeframe. To understand what's happening behind the scenes, let's drop down to a lower timeframe, such as the 5-minute chart. On the lower timeframe, we can see price creating a bullish market structure with strong buying pressure. Many traders place buy limit orders at areas like order blocks, expecting price to retrace and fill them in. However, because the market moved so aggressively, many of those orders were left unfilled. This is where the fair value gap becomes important. The fair value gap contains a concentration of pending buy or sell orders, creating a pool of liquidity within the imbalance. That's why price is often drawn back into the gap before continuing in its original direction. In simple terms, the pending orders inside the fair value gap act like a magnet, attracting price back to fill the imbalance before the trend resumes. Now let me share 5 practical techniques I use to filter out the noise and focus only on the highest probability fair value gap setups. Tip number 1, prioritize the right fair value gap. On this chart, we have multiple bullish fair value gaps at different price levels. The lowest fair value gap is always the strongest and should have the highest priority, while the highest fair value gap is the weakest and should have the lowest priority. In an ideal scenario, you should always look to trade the lowest bullish fair value gap possible. The same principle applies to bearish fair value gaps. When you have multiple bearish fair value gaps, the highest one should have the highest priority because it offers the best risk-to-reward opportunity. Tip number 2, size matters. Larger fair value gaps generally provide stronger and more reliable setups. A wider gap represents a more aggressive market imbalance, making it more likely that price will revisit and react from that area. Whenever you have multiple fair value gaps on the same chart, prioritize the larger ones over the smaller ones. Tip number 3, trade only unmitigated fair value gaps. The best fair value gaps are fresh, meaning price has never returned to test them since they were created. Once price retraces into a fair value gap, it becomes mitigated, reducing its probability of success. If a fair value gap has already been tested, it's usually better to skip it and wait for a fresh opportunity. Also, pay attention to how deeply price retraces. If price closes inside or completely beyond the gap, the setup becomes invalid. Ideally, you want price to tap the fair value gap, respect it cleanly, and continue in the intended direction. Tip number 4, watch for opposing order blocks. One of the biggest mistakes traders make is buying or selling from a fair value gap that's positioned too close to an opposing order block. For example, a bullish fair value gap sitting directly beneath a bearish order block is a warning sign. Price may rally into that order block, reject aggressively, and invalidate your setup. Always check the surrounding market structure. Avoid trading fair value gaps that are too close to major support and resistance levels, psychological price levels, or significant swing highs and lows. Tip number 5. Trade fair value gaps that form after a break of structure. The highest quality fair value gaps are the ones created immediately after a break of structure. When price breaks a significant level and leaves behind a fair value gap, that imbalance often becomes a high probability area for smart money to re-enter the market. Let's put our knowledge to the test. Take a look at this chart example. We can see what appears to be a fair value gap right here. But here's my question for you. Would you trade this gap or not? If you said, no, I wouldn't trade it because there's no break of structure, you're absolutely right. This fair value gap is not valid because price failed to break the previous high. Without a break of structure, we don't have confirmation that the market intends to continue in that direction. Now let's look at a different scenario. Here, price breaks above the previous high and creates a fair value gap in the process. This fair value gap is valid because we now have the crucial break of structure confirming the move. Here's another example. At first glance, this fair value gap looks perfect. It's large, it formed after a break of structure, and it's still unmitigated. So, would you take this trade or pass on it? If you said pass on it, you're thinking like a professional trader. Even though this fair value gap meets most of our criteria, there's a bearish order block sitting directly above it. That's a major red flag. Price could rally into the order block, reject aggressively, and completely invalidate the fair value gap setup. If you found this video helpful, kindly give it a thumbs up and subscribe. It won't cost you a dime, and it really helps support the channel.